Okay, good evening, everyone. Welcome to another Money Weekend with me, Kalu Aja. Of course, on our space here, we call it our money space. We're talking money, the economy, and finance. And today we're talking personal finance. We're talking how to trade 101, which means there's 201 and there's going to be lots of other series. But what we want to do today is not to give you signals or tell you what stock to go and buy. What we want to do is to give you the discipline, to show you how to do it, the disciplined way to trade. Lots of you are doing it wrong. Lots of you trade and maybe doing it a bit wrong or not doing it the way it's supposed to be done professionally. So on this space, we just want to review what you're doing, right? Pick a few things you can from this space. It's also on YouTube. If you go on my tweet you will see the YouTube link I shared there. Get on the YouTube link because we're going to do a lot of visuals, right? Because we have the visuals, I would advise that you hop into the YouTube so you can see it. I'll also try to share the visuals on here, but trust me, guys, you want to see it so that way you can sort of follow, right? So fantastic. So the YouTube link just going to be on the one of the last things I shared just before we got online. So yeah, see you guys already hopping in and we'll get through it. So again, it's not a page for signals. It's not a page for what to buy or what to sell. What we're trying to do here is essentially say, hey, can we have a disciplined way on how to approach trading? That's what I want to do today. If there's a need to do part two and all that, we will do it. But, but for now, it's just gonna be only. Sorry about that. It's gonna be just how to approach trading. I'm gonna do three things. Number one, what to do before you trade, how to arrange your information, how to arrange how you want to approach the market. We're gonna do that first. Then we're gonna do what to do when you are now in the trade. And then we're going to do what to do to get out of the trade. And all these three are three distinct stages. Number one, how do you get in? Number two, when you are into the trade, how do you stay in? What do you watch out for? How do you ensure that you are not going to lose out? Again, look at what's happening in South Korea. Their market went up. It's been going up for the last 2 years. When you look at the emerging markets return, for the last 2 years, notice when it's printed out that the emerging markets are beating the US market. The US market is the largest and most liquid market in the world. It's always number one, but emerging markets tend to be the US market. When you drill down, that emerging market was all South Korea. Not just all South Korea, just two stocks in South Korea, Samsung and SK Hynix. So imagine if you're a young guy in South Korea, there's this particular stock, SK Hynix. You know Samsung, but it's SK Hynix. It came from nowhere. It's making chips. Your friend buys at $100. It goes to 200. Your friend takes a loan, buys more at 200. It goes to 400. Takes a new loan, buys at 400. It goes to 800. You are there buying your normal ETFs and your normal South Korean market. You're not buying that stuff because it's risky. But your friend keeps on buying. Now he's nearly at ₦1 million, $1 million return. Your friend from borrowing, he's gone from $100, I'm giving an example, guys, to a million. So you start to look like a fool. In finance, we call it the fear of missing out. That's what starts to happen to you. You say, wow, I'm missing out. And when they interviewed South Korean youths, they were like, it's better I lose money than I die of missing out. Because when you miss out, it's a bad feeling. You feel like you are cheated. It feels like people were doing something and you didn't know what's happening. So you missed out. It's a very, very bad feeling. So FOMO is a very, very powerful force in the world of finance. So because of FOMO, you also go, you sell your house, sell your car, and you buy that same stock. The same stock also doubles. Then you tell your friends, wow, I got in at a million, now I'm at 1.5. Your friends also get in. So a self-perpetuating cycle then starts. More people buy the stock, so the stock price goes up. There are more people buy the stock, then the stock price goes up. So the stock price is detached from fundamentals. It's now a bubble. And when it's a bubble, eventually it will crash. That's what happened in South Korea. But if the South Koreans had watched this show that you're watching today, they wouldn't have lost money. yes, they won't have lost money. So what I'm teaching you here is how to trade without losing money. And you'll see what I'm trying to show you. But I'm going to say, is it possible? I'll show you how. So what I'm going to do in this course, again, if you're on YouTube, it's showing. If you're on Twitter, just follow the tweet slides. You can see it. Make sure you follow the slides so you can follow visually. We're going to teach you how to choose what to trade. We're going to teach you how to size your positions correctly, how to set stops, how to take profits, and of course, how to journal and how to improve. That's what we're going to work out today, right? Let's first of all start with this header. Is trading, buying stocks, is it gambling? You know, Nigerians do a lot of sports betting. That's gambling. There's no argument there. But is buying stocks gambling? I think the process is almost the same, but stocks have one key thing that gambling does not have. If you are gambling, the only way you can avoid losing is not to gamble. So if I invest money and I say a club will win, it's either I invest or I don't invest. But once I'm in that bet, I can either win or I lose. There's no other way to do it. But with trading, it is possible to place a bet and to specifically tell the system, I don't want to lose money, or I want to lose only 2%. It's possible. So you can actually place a bet and say from before, as you're placing that bet, I don't lose money, or I'll lose only 5%. And it's possible. You can do that, and you can make money, and you can avoid losing your principal or a lot of your principal. It's possible. I think that's the key differentiation between trading and gambling. Gambling is hoping. But with trading, if we follow a tested process, it's possible to have those risks in place that can help you avoid losing, right? So professionals, most of what the guys you see on Wall Street, they manage the risk first before they trade. When you look at Wall Street, so those guys screaming, they've already bought according to this formula I'm going to show you, right? They are managing the risk first before they get into the trade. So again, once we're done with the slides, if you have questions, yes, you can go ahead and ask, but I'm just going to go through the slides. If you feel you have a pressing question, you request to speak, I'll take your question. But otherwise, just sit back and enjoy the presentation. And at the end, we'll then take those questions. So let's now go to why traders fail. Most of you guys have been trading. I know Nigerians trade a lot of crypto. We do a lot of currency trading. It's the same thing here. Why do Nigerians or why do folks fail when they are trading? Number one, they are trading without a plan. They are doing FOMO. Their friend says buy currency CFDs. They bought currency CFDs or they bought Bitcoin. They didn't have a plan. No plan to enter, no plan to go out. So they're going to fail. They took too much risk on a trade. They took too much risk. They have no exit strategy. How do they sell? What price do they sell? They didn't have all that done. And of course, emotions. They let emotions take control of their decisions. They became invested. They married the stock. The stock is not your friend. The stock makes money for you. You don't marry the stock. It's not your wife, right? You want to be not emotional when you are trading. Very, very important. So that's why most people lose money. So the way to avoid losing money is to trade with a plan. Don't risk too much in a trade. Have an exit strategy. And of course, control your emotions. It's pretty simple. When I'm talking numbers here, if you notice, I'm not talking numbers. Once I talk numbers, a lot of you run away. We're not going to talk numbers. We're just going to go in and tell you the psychology of it. And I'm going to give you the tools that you can use going forward, right? So let's go ahead. Now, the first thing you want to do when you want to trade is to try to trade what you understand. If you don't understand what Bitcoin or cryptocurrency is, then how can you trade it? I mean, understanding what it is, what it's all about. You see, the Bitcoin bros will tell you, read the white paper. Follow them and read the white paper because you have to understand the thinking behind the approach that you're buying. If you're buying stocks, who is Warren Buffett? If you don't know who Warren Buffett is, why are you buying stocks, right? You've got to understand the psychology behind that trade, not even the individual trades, but the psychology behind the trade. And you can trade anything. You can trade orange, you can trade currencies, you can trade carbon. But try to trade in the market that you understand. If you don't understand global politics, you're not interested in watching CNN or reading about the news, you shouldn't be trading currencies. When you trade currencies, you are trading on international news and politics. Morocco, some guys in Morocco just went into Spain. the Schengen was suspended between Italy and Spain. What will that do to the euro? If you don't understand what I've just said, you shouldn't be trading currencies. Very simple. So you've got to know what's happening. So just like in Nigeria, if you don't know spare parts, you can't go and trade spare parts. If you don't know cows, you can't go and open a butcher. The same thing. Try to understand the market before you trade. If you don't know it, try and learn before you get in. That's a simple one. Again, guys, no numbers, just common sense so far, right? And we're making sense, right? So again, understand the market that you want to trade in. And number two, understand the assets that you are trading. How do those assets behave? How do shares behave when interest rates go up and down? I'll give you a good example. When you trade bonds, when interest rates go up, bonds must come down. There's no argument. When interest rates go down, bond prices go up. No argument. That's for bonds. I mean, fixed income that pay your return. If you don't know this, then you are not going to watch interest rates. The other traders are going to be watching interest rates. You're going to be watching coupons. So you're going to lose that trade. The same with stocks, right? What does the price to earnings ratio mean? If I look at a stock and I'm buying that stock for my retirement or for 10 years, I'm not interested in the price differential every day. I'm not interested in the volume. I'm interested in the market size and the earnings. I say it again. If I'm buying that stock for a long time, I am more interested in the earnings and the market size of that company. I'm not interested in the volume trader day by day. But if I'm a trader, I don't care about the market size. I don't care about the earnings. I'm interested in what my friends are buying so that I can buy ahead of them and sell to them. That's the psychology of the trader. So you want to ask yourself, yes, I understand the market, but what am I doing? Am I buying for long term? Am I buying for short term? If I'm putting money in my RSA, my retirement savings account, or my 401k, I shouldn't be trading those funds. That's not where I trade. Those are the funds I buy, I soak away, and I leave for retirement. But I can have a brokerage account where, I hear SK Hynix is going up and down. I trade it. It doesn't mean I can't have both I can have Apple in my 401k or my RSA, but I can trade Apple in my brokerage account. So you have to know how those assets behave. So now, what are we saying? Number one, you want to know how the market behaves. Number two, you want to know how the assets you are trading behave. We all know oil goes up when there's tension. So if I'm trading oil, what am I watching? Am I watching the price of oil or am I watching Donald Trump's tweets? You can't trade oil if you're not following Donald Trump's tweets, because Donald Trump's tweets move the price of oil. If he says I'm going to bomb Iran, oil price goes up. If he says there's going to be peace in Iran, oil price comes down. That's what's happening in reality. So that's why you have to understand the asset class, understand what are the triggers to price movement. If you are doing Bitcoin as well, you know that the real thing for Bitcoin today is going to be the passage of that law in America, right? If the American Senate and the Congress passes that law that they want to pass on crypto assets, then Bitcoin is going to go up to that 100. So there's no point watching what the guys in Binance are saying. The real driver for crypto is Donald Trump, the US Congress, the US Senate, if they can pass the Crypto Act and get it to Donald Trump's desk. If they do that, crypto goes to 100,000. It's simple. So if you know your assets market, you know your asset classes, you know your triggers, that's you preparing before you go into the market. You have to know that. You can't guess it. You can't say, I wish it, right? So we are now still talking on what to do before you trade. We've said number one, know the market. Number two, know the asset class. What's number three? You have to get a trading budget. What's a trading budget? You want to say I earn 100, just for example, I earn 100,000, right? Okay, how much of that 100,000 can I afford to lose? Don't say you're going to gain. Can I afford to lose? If you say I can afford to lose 10,000, that's your trading budget. That's the money you can lose and still sleep at night. It won't make you go mad. So that's your trading budget, 10,000 naira out of 100,000. It could be more, it could be less. I'm very wary of people borrowing to trade because you are already tensed up. You're already trying to cover your costs. But if you are, it is the money you make, maybe you have money you're not paying interest on, or you have money lying around, you can say, okay, out of this money I have lying around, what is my trading budget? I have about 10%. Okay, that's your trading budget. You want to keep your trading budget separate from your living expenses, which means you don't take your rent money to trade because you want to make more money and then pay rent. You don't do that, right? You want to use money. Again, look what I'm saying. You can afford to lose. I didn't say money you're going to make a profit on. That you can afford to lose. That's your trading budget. Because you have to be healthy for you to trade. If you are worried about the market and you cannot sleep, you should not be a trader, right? It's very, very simple. Not everybody can play basketball. Not everybody can trade. If you are a worrisome person and you cannot take rejection or loss, you should not be a trader. So know the market, know the stocks, have a trading budget, right? Know the market, know the stocks, or know the market that you're buying, have a trading budget. What's the next thing to do? You have to determine from that trading budget what's going to be your position size. What I mean now is that if you want to, let's say you decide to trade currencies, right? What is the position size per trade? So if you say I have 20,000 naira and you then say I want to go and buy trade on Monday, how much do you risk per trade? Again, not per asset, per trade. So I want to buy dollar, or I want to buy stocks, I want to buy Nestle. How much am I going to trade anytime I want to trade? You have to have that number. It's going to be a percentage of that trading budget. You can say it's 1%, you can say it's 2%. The professionals say don't put more than 2% on a single trade. Remember, they're not asking you not to hold more than 2% in a particular stock. They are saying don't trade more than 2% of your capital in a single stock. So if my income was 100,000 and I said my trading is going to be 20,000, in that 20,000, they say don't put more than 2%. So 20,000, 10% of 20,000 is 2,000. 5% is 1,000. So you can see how they're taking it low for you. So that's what you want to do per trade. So if I want to say I want to trade Nestle, I'm trading 1 to 2% on that trade. I can do 2 trades a day, but on each particular trade, I have my position size. I don't reduce it. I don't increase it. That's just my size. So if I tell my broker, I want to buy Nestle, I'm saying in my head, I want to buy 2 positions or 3 positions of Nestle. So I'm buying that 2, which it might be 500 naira or 1,000 naira or 100,000. I'm buying it 2 times or 3 times. You have to think like that. Where's that money is going to be still in your trading budget, in your brokerage account. So from your brokerage account, you trade 1 to 2% of that. So let's recap. Number 1, know the market. Number 2, know the stocks you're trading in. Number 3, know your budget. How much of them can you take out of your account and trade? Number 4, what is your position size, right? That's number 4, your position size. Number 5, what is now your minimum? Remember, the trading size also has to do with what you are buying. If you are buying, for instance, currencies, they have micro, mini, and standard lots. So you can't say, for instance, I want to buy currency with $50, right? Because it might not buy you the micro lot. So if you are doing commodities or currencies, you need much more capital to trade because that asset class demands much more. If you are buying shares are fractional. You can say you want to buy a fraction of a share. So you can go and buy a fractional share. If you maybe go to Bamboo, you can buy the ETF or you can buy all that. But you can't do that with, say, currencies and all that. So your minimum size has to match with the market that you want to buy, right? Keep that in mind. So when I'm saying I want to do my minimum, it has to tally with the market I want to trade, which is what I said from the very start. Know the market you want to trade in. Get your budget, get your position size, then you only trade according to multiples of your position size. Never risk more than 2% on a trade. Not on a stock, but on a trade. Don't risk more than 2% on a trade. Hope you're taking notes, guys. If you're not taking notes, it's going to be recorded. I have great slides here for you to go back and look at, so you guys can also just basically have all this, which you want YouTube, also sharing the slides on Twitter, right? All right, what next then do we do? So now you have done your pre-work. You have researched your market, you've researched the assets you want to buy, you've determined your budget, you have your position size, i.e. the minimum amount you are going to use per trade. You've done all that. This is now when you want to now enter into the market. So how do you know when to enter? How do you know when to enter? There are many ways you can determine that. You can say, okay, this is how I want to enter into the market. You want to either use the trend. You can say, oh, I'm just going to wake up and I'm going to look at the trend of the market, and I'm going to maybe look at the top trading stocks by volume. I'll pull that stock down and look at it, and I'll say which is the highest volume so far. Because if there's volume, there's activity. You can't trade where there's no activity. Remember, we talked about on this space about having a highly capitalized stock that does not have volume. That's why the NSE has said you must trade volume for the price to move up. So if you're a Nigerian guy, before the NSE changed those rules, you could go and buy those low cap stocks that are not in the NGX 30 that you can put 50K and move the price up and down and put trade and buy. Now they've changed those rules, right? Or don't to change those rules that you must have like 500,000 trades to move the price up and down. So there's less volume there, less volatility there. You want to go to where there's volatility. Is that volatility that you are trading on? Again, guys, pause. We are only talking trading today. We're not talking fundamentals. So you're not going to be hearing me say earnings, PE. Those things don't matter to traders. Traders are looking to enter cheap, sell high. So they're looking at volume, transactions, trend, level, confirmations, resistance, support. That's what they are looking at. You want to trade when your own determination has been met. So if you say, I only will trade a stock that has an RSI, relative strength index, I don't want to get into that now, that let's just say that has a volume of ×2, or is the top 3 trading stocks. Let's just use that one, that's easier. Let's say I want to only trade stocks that are posted as number 1 or number 2 in that trading cycle I'm looking at. If that's your entry rule, write it down. So everything you are doing now, everything you are doing from when we started to talk, I'm going to give you guys the journal. At the end of the space, I'll post the journal, print that journal out. That's what you're going to use. Write everything down. So if you say, I want to buy Nestle or GT, and I'm going to buy GT because when I looked at the Nigerian stock market, I looked at the top 3 trending in volume stocks, and it was Nestle and GT. So I want to then buy Nestle and GT. How much am I buying? I want to buy 2% of my trading budget in this one trade, and I want to buy it 2 times. So I'm going to buy 2, right? Percent. That's what you're doing. So you've taken your trading budget, you've said, I want to buy, you said, what market do I want to buy? I want to buy Nigerian market. What sector? Nigerian stocks. What's my trading budget? 200,000. Okay, I want to buy GT. What in GT? I want to buy 5% of my trading budget per trade. Then I now invest in GT. You see how we've done it? Discipline. I've written it down. What made us buy GT? Write it down. I looked at the trend, looked at the volume, write it down. So you only trade when your criteria is met. It's your own criteria. I'm not going to come here and tell you, use this. That's going to be a trading 201. For now, we're doing trading 101. Trading 201, we're going to show you how to look for those criteria before you enter. But trading 101, we're going to say, get that criteria and only trade when you have hit that criteria. Now, the question is now, how many times should you trade? You are into GT. You bought GT on Monday, right? Should you buy it on Tuesday if the price is going up? Should you buy it on Wednesday if the price is going up? Quality over quantity, guys. Remember, more trades do not mean more profit. The more you trade, the more you are increasing your size of that particular stock, which means if you are trading GT and tomorrow First Bank becomes a killer, you don't have any ammunition to do First Bank. Doesn't mean GT is bad, but you're losing a lot of opportunity here. Remember, you're a trader. You are buying and selling. You're not buying to hold. You are buying and selling. So how many times should you trade? More trading does not translate to more profit. It generates more transaction fees. Over trading destroys accounts. That's why we make you trade according to your lot size. Because if you say your lot size is 5% of your budget, If you trade 2 times, that's 10% of your budget on a particular trade. How many trading opportunities do you think you have in a day? Every day can bring 5 opportunities. So if you spend 10% on just one trade, not one stock, on just one trade, what's left over? So discipline, we're back to discipline. Say, okay, till I unwind this one, I might not trade this one, or I'm not going to over trade, or I want to keep cash in reserve for other opportunities. That's how the discipline comes in, by making you trade only to lot size. Because if you have a lot size, you say, okay, I'll buy 100 here and I'll buy 20 here. No, you have to buy the same. So I had to force you to say, should I put 10% in GT and only 5% in First Bank? That's what's forcing you to do. So be careful about over trading. It will kill you by generating a lot of fees, right? Now, this is the key thing. I mentioned this to you in the past. Let me just say it again. When you are trading, your issue is not what you think will make profit. If you are a trader, you are not saying, I like GT. You're not saying, I like Zenith. No, you are saying, my friends like GT. My friends like Zenith. You are trying to buy what other investors are buying, because that's when you can buy ahead of them, sell to them, and exit. If you buy only what you think is profitable, what if nobody agrees with you and you are right? Remember, you are right, but nobody agrees with you. The market, there's a popular phrase in the finance terms. The market can stay illiquid. Market can stay liquid longer than you are right. Which means if I go and I buy Bank X, because I think Bank X is a better bank in all the banks in Nigeria, but the market says Bank Y is better, who will lose? I will lose. It doesn't matter if I'm right. What matters is what the market is saying. That's why the market is never wrong. The market is never wrong doesn't mean that the market is right. It's that the money is going to go with the market, and you that you are correct will lose out. The folks that make money, the contrarian investors like Warren Buffett that make money, are the folks that have the capital to be wrong and to stay in that wrong position till the market comes back and finds them. But if you're a trader, you're a scalper, you are an in and out guy, why are you? Don't argue with the market. If the trend is going up, you should be going up. You're not a hedge fund. You're a trader from Lagos, right? If the market is going down, you should be going down. You're not there yet to say, oh, I think the market is wrong. So if the market is going down, I'm going to be going up. Be careful with that, because you are a trader. So you are picking what you think the market is doing. You are trying to get ahead of the market, or come after, or get ahead of the market. That's what you're trying to do. If you come after the market, you've lost. You are buying the trade that's already decayed, right? So that's a key point for us to know, because many times we think we know what we're doing, and we're not watching the volume. We're not watching the world events, right? You can say, for instance, that I don't think the US should bomb Iran. No one cares about that. The point is they are bombing Iran, so oil price is going to go up. So if oil price is going to go up, you can't bet that the oil price is going to come down. You see the point I'm making? It's what you think or what your emotions are is immaterial. Remember what we said at the top. We're not emotional. We are following data points. So if we know oil is going to go up, we've picked our market, we've picked our lot size, then we trade our lot sizes. Because we've looked at the trend. What was our trigger? We looked at the trend. We looked at Mr. Trump's tweets. That was our trigger, because we have to write why we are engaging. We write it down. Very important. Why we took that trade. So that we can go back and review. Oh, RSI works. Oh, Trump tweets work. That's the whole idea, guys. Yeah? Okay. Let's move on. It's getting more juicy. Now, this is where I think I want to spend the rest of my space on, right? Stop losses. When I did this presentation, I had nearly 100 slides, and I had to whittle the slides down to what I thought would be most beneficial to the folks that would join and listen. And stop loss is one thing that I think everyone has got to see. You know, when I started at the beginning, I said, what's the difference between gambling and trading? Gambling does not have stop losses. You can't go to the casino and attempt to play roulette and say, I only want to play roulette for if I win. No, once you put in, you're rolling. You throw your dice, you're rolling. You can't take it back. They'll tell you, bet over, you throw your die. But in investing, it is possible for me to trade and to tell the market I don't want to lose more than 1% or 2% or whatever. I can tell the market that. How? I use stop losses. And I hope everyone in this space is using stop losses. If you're not using stop losses, we're going to spend some time. Even if this is all that we do, stop loss, we are fine. We are fine completely. What's a stop loss? A stop loss, just like the name implies, you are stopping your loss. You are stopping your loss. How do you do that? Essentially, I have an example here on the screen. Let's say you buy Bitcoin at $22,000. I go in and I look. If you look, most trading apps, you see stop loss. You see them say apply stop loss. I know Bamboo has it. If you see apply stop loss. You can go to stop to and apply a stop loss just below your entry price. So in this case, I entered Bitcoin at 22,000. So I'm putting my stop loss at 2% below Bitcoin price. So my stop loss is 21,560. What does that mean? That means if the price starts to go down, it will automatically sell at 21,560. So how much have I lost? I've only lost 2%. I can tell the market exactly how much I want to lose. I can make this 1%, right? I can make this 10%, according to how aggressive I am. So if I'm very, very conservative, I'll say 1% stop loss, which means the share just coughs, sell. Or I'm very aggressive, I'll say, hey, make it 5%. So I'm willing to take losses because I think the share price will kind of go back up. So I'll put 5% stop loss. Or I can just put a 2% stop loss. If I do a stop loss, I'm saying from that my trading budget, the only loss I can make is 2%. That's what I'm saying. So when I take that trade, I'm doing my 2% per trade. If I do my 2% per trade and I put a 2% stop loss, I'm saying per trade, I can only lose 2%. How much can I gain? Unlimited. Because the stock price can go to unlimited, right? But I can only lose 2% because I put in at 100% and I put 2% to take me out. So if I'm wrong, if I looked at my reason for trading and I said Trump tweet, and I bought the stock because of Trump's tweet, and Trump then did a tackle and reversed, I can only lose 2% because my stop loss will kick in and the market takes me at 2%. This is what you should have done, right? And this is what most of the guys, I think, in Korea did not do. There was no stop loss. If you had a stop loss, and we're going to go into trailing stop losses as we go along, you will now see that if you had a stop loss, you don't lose your principal more than what you set the stop loss to do. So if you're not doing this, you've got to start doing this. Let's talk more about stop loss. Like I said, if it's all we talk about and I leave here, you guys have gained something. I'm going to sleep a better man, right? Now let's talk more about this stop loss. Never now. I bought Bitcoin at 22,000. But remember when I bought Bitcoin, that's the stock, the price was 22,000. But I paid commission, I paid SEC fee, I paid commission to the broker. So my total cost was maybe I bought Bitcoin at maybe 21 something, but my total cost was 22,000. So I have a break even. Break even is going to be my total cost, all in. So once I have set my stop loss, let's go back to that slide. I bought at 22,000. I put my stop loss at 21,560. What happens if Bitcoin goes to 24,000? What do? I move that stop loss up. I move it up. Do I sell? No. Now we're talking trading. I don't sell. What do? I move my stop loss higher than my break-even price. What's the break-even price? The price that I've covered my commission. Let's say I'm trading with margin. And I gave the broker 10,000. The broker gave me 10,000. Let's just assume for simplicity's sake, that the stock price has got to go to 25,000 for me to be able to sell, pay the margin cost, and make a profit. So my stop, my break-even point to pay the margin, to pay the commission is $25. I bought at $22. What happens if the price goes to $30? Do I sell and pay the broker and make a profit? Not really. What I could do is I could move my stop loss higher than 25 to 28. What have I done? I have said that whatever happens, if the stock price comes down again, it sells at 28. I pay the broker, I make a profit. But if I don't put that stop loss and if I sell What if the stock goes to 50? Then I've lost money because I could have stayed on that trade from 25 to 50. So you see what we're saying here? Move your stop loss. Your stop loss is not static. You move it. So if I bought at 25 and my break-even point is at 35 and the stock price goes up to 40, what do? I move my stop loss from 25 to 39. So I've guaranteed myself that if anything happens to the stock, I get paid. I paid the broker that I took margin from, and I'm happy I can go to sleep. I don't have to watch the system. I can go to sleep. So it's called a trailing stop. Trailing stop. So as the stock is going up, I move it up. As stock is going up, I move it up. If the stock comes down, as long as the stock price does not get to my stop loss, I don't sell. I just wait with them. If it goes up again, I move it up. So that's my job. When I come in the morning, I look at the price. I say, okay, I already have my break even. I look at all my positions. Oh, this one has gone up in price. I move my stop loss up. Right? That's what I'm doing. That is the discipline I'm bringing to trading. I looked at the market. I looked at the stocks. I got my budget. I set my minimum share price. I determine what will trigger me to buy. The trigger flashed green, I bought. When I bought, I immediately put a stop loss so that I don't lose my principal. This is not to make a profit, I don't lose my principal. The stock price went up. I moved my stop up higher. I'm targeting my break-even point now. Once I cross my break-even point, fantastic. If the stock goes up, I move my stop loss up. I keep on following. I don't have to sell. Because if the share price goes down, I'm a trader. The share price goes down, my stop loss takes me out at profit. That's why I say you can trade without losing or limiting your losses with stop losses. That's the point I made at the very beginning. It's called a trailing stop loss. You don't keep it static. You keep it trailing. And this is a good illustration that I did here. I went online. This guy's, what's their name? Chat. Their name is somewhere after I'm sure. Parallel Chat, I think that's the name of this guy that I got this visual from. If you look at what they've done here, they've just done it perfect, right? If you look at the picture, the blue line is a stock price. The blue line is a stock price. The green is my trailing stop. So you can see, once I bought at the blue line, let's say that blue line was $20, I put my stop at 18. The market price moves up, I also move my stop loss up. The market price came down. Did I sell? No. Why? Because the market price did not fall below my stop loss. I'm still in the money because it's moving higher than my break even. I'm still in the money. There's no need to sell. I stay right there. The stock price goes up again. I move my trailing stock price up again. When do I sell? I only sell, guys, when that price, the market price, has now fallen below my stop loss. That's when I can take myself out. You see that? When the blue line crosses that green line, which means when that blue line, the share price, goes below my stop, my trailing stop, I can go out. I've paid myself. I've paid my margin, guys. I'm in the green because I've chased the stock price high, and as long as the volume, more sellers came to the market, and then there was more volume, the share price had to go down, I'm exiting. In this scenario, I've maximized that trade. I haven't left money on the table. I got in at 20, the share price went all the way to 30. I didn't lose money. I ran that trade all the way to the top, right? And then I was able to then sell, right? Chief Enna, did you have a comment?
No, I have a question. John 1:5, light shine in darkness and not comprehend. So my question to you, Carlo, just because I like your educational spaces. Now, in real terms, I buy a share, say $50 4 months ago, and you said I should do the trailing sell and stock it at $60 to sell. If within that time, cost of living has risen, say by 10%, and secondly, also can you explain the tax implication? And thirdly, let's say inflation. What are the other parameters that can affect my sale, even though I bought at 50, but sold at 100. But in real terms, let's say in 3 months' time. So I want you to discuss 3 things: time, tax, cost of living, inflation, and any other parameter that you think can affect. Even though I'm seeing the numbers from 50 to 100, I made 50, but in real term, I've made nothing.
That's a good question, right? So when we are trading, we are focused on what's in front of us, i.e., making money on the trade. So your question is now, let's say I've made $100,000 profit, right? Number one, if you trade, you are exposing yourself to taxes. In the US, for instance, not in Nigeria, in the US, there's what they call long-term and short-term taxation. If you buy and sell a stock within 1 year, you pay a higher tax than if you buy and hold that stock for more than 1 year. So Warren Buffett, you should always hear them say Warren Buffett pays a lower tax than his secretary. That's why he pays a lower tax, because Warren Buffett does not sell. So he has no actualized profit. He buys, he holds for more than a year. So even if he sells after that 1 year, he's paying a lower tax than you and I that are buying and trading. So that's number one thing for taxes. Number two, inflation is the stock price you're looking at. If there's inflation, what happens to the stock prices? Some will go up, some will come down. If the stock is a consumer discretionary, and I have to buy Dove soap, or I have to buy gas for my car, inflation goes up, gas prices go up if it's elastic. So inflation is in that share price that I'm chasing and trailing my stock prices on, right? Number three, cost of living is the exact same thing. Cost of living is inflationary. So if there's low inflation, cost of living gets better. So if I'm trading, I'm making that revenues to sort of supplement my cost of living. The point, guys, when you are trading, make sure that you are looking at the system in front of you, right? These things that Enna has mentioned are things you worry about, but are not on the screen in front of you. They affect the stock price. Inflation goes up, bond prices go down. Inflation goes up, some stocks go up, some stocks come down. That's your worry, the trading in front of you. But these things are things that you want to worry about post-trade. If you say, I've made a profit, you have to pay taxes because the US has got the carbon copy of your trade. So you must make sure, that's why I said record it. Now, most companies, when you buy and sell, they will give you a report of that trade, your 1099 interest or 1099. You basically take that and you report your profits. And have I addressed that issue for you?
Yes, and just pushing it further. I remember once, I think I've seen your space where you talked of how the S&P 100 has done against individual stock. So you, as someone advising now, based on risk, and we know some sectors are high risk. So would you want to also explain risk and bundle like S&P and single individual stock?
Yeah, well, first of all, I'm not advising. This is an educational space, so I'm just talking, I'm just educating folks about the markets. I'm not asking to go buy or sell any share. This is a total disclaimer and all that. I'm not your financial advisor. I'm not holding myself as a financial advisor. So, number one, when you want to look at, let's use football, because it's easier to explain things with football. If I came to and I told you who would win the EPL that's going to start in a few months, will it be Chelsea? Will it be Arsenal? Will it be Man City? Will it be Man United? It's a difficult call to make. There are 4 teams. You have to put all, and I tell that whoever wins, I'll buy you a house. So if you guess right, I'll buy you a house. That's a tough call, because even though you're an Arsenal fan, you want that house. So you don't want to make a mistake. You are very, very serious about that house. So you're going to be researching, who has Chelsea bought? Who has Arsenal bought? What's the Arsenal pitch? What's the weather in Chelsea? You're going to be doing all that because you are doing your fundamental research on the individual stock. Do you have the time for that? Do you know what the coach of Arteta is thinking? You don't have the time, the resources to know what Arsenal, Chelsea are thinking in their boardrooms. You don't know. So what's the easiest way for you to know this? You tell me, oh, I want to just bet on all 4 clubs winning the EPL. How can all 4 clubs win the EPL? What if there was a product that I could buy that would buy shares of Arsenal, Chelsea, Man U, and Man City? That's what an ETF or a mutual fund is. You are diversifying your bet from 1 to 4. So if Man U wins, you got the house. But if all 4 get the Champions League, you don't get the house, but at least you get a BQ because all 4 have won. So when you buy mutual funds, you are diversifying and you are buying 4 companies at a cheaper price, even at a fractional price. That's why they are quote unquote the entry to you to get into the market. If you try to buy individual stocks, you don't have the money or the time or the expertise. But when you buy a mutual fund on ETF, there's a manager managing them. If they are passive, there's no manager. You get in, it's cheaper, you get exposure to all of them. So like I always tell people, if you want to buy stocks as a whole, you have to be exposed to the US market. But with stock in the US market, US has tons and millions of stocks. You don't know which one. So buy the ETF that holds the whole US market. VTI is about 3,500 US stocks. VOO about 500 US stocks. It's tracking the S&P 500. That's how you start if you want to start. Then from there, when you are now more comfortable, you can get back and say, okay, I want to buy this one or buy that one. And fantastic questions. Let's go right back, to the stop loss. So we've talked about the trailing. Remember, you put the trailing first. When you start the trailing, you put your stop loss just below where you bought. If the stock price moves up, you move up. Stock price moves up, you move up. Your target is first of all to get your break-even point, especially if you're a margin trader. So that stop loss is what you're actually trading, not your stock. You've bought the stock, right? The stock is now 10 naira. The stock goes to 12 naira. You put your break-even at 11 naira. The stock goes to 15 naira. You put your stop loss at 14 naira. The stock goes to 20 naira. You put your stop loss at 19 naira. You see what you're doing? You're not buying and selling. You are inching that stop loss up, 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 up to chase the stock. What if the stock goes down to 18 naira? Do you sell? No. It hasn't yet hit your stop loss. It's only when the stock price hits your stop loss, boom, you are out. But you are out at a profit. You rode the stock going up, and then you got out as the stock tried to come down. Again, why do stocks go up and down? Volume. If people are buying, stock goes up. People are selling, stock goes down. So you are trying to ride, like I said, what are your friends buying? If your friends are saying not to go and buy Arsenal, you go and buy Arsenal today. As Arsenal starts to win, more people buy Arsenal, Arsenal's price is going up. Once Man City catch Arsenal and beat them, Arsenal price is going to come down. Do you sell? No, because it's just one game. So your stop loss for Arsenal is just below. So Arsenal starts to beat Birmingham and all that, their share price is going up. Until they get to a stage, maybe they get to the last 5 games. And as usual, sorry folks, maybe Arsenal loses. Then their share price now crashes. Once it crashes below and hits your stop loss, boom, that is when you sell, boys and girls. You trail. That's your trading. Not trading is not buying, sell, buys today I bought. You're not Gordon Gekko. You're a disciplined trader that looked at the market, looked at the asset class, got a budget, got a per unit price, got his minimum trading volume, got his triggers, bought the stock, then put a stop loss. Let's move ahead to one more slide. Now, we've talked about stop loss. Some people say, I don't like this stop loss thing. Or my broker does not have stop loss. Kalu, what else can I do? There's something called scaling. Scaling means that you scale out. You can scale in, you can scale out. With scaling, it just means that when you buy the share price goes up, you sell some. The share price goes up, you sell some. You sort of like you exit. So if I was in South Korea and I bought SK Hynix at 100 won, right? And it went to 500 and my cost plus my margin was maybe 200. Okay, I'll sell some and pay the margin guy. So I've reduced my quantity, but I no longer own anybody. I've scaled out at 50%. I now hold it because now it's now mine. I'm not worried about margin. The wahala is always margin. It's not that the share prices go up or down. When markets crash, it's not that share prices went up or down. Share prices go up and down every day. But markets crash because there's leverage. Folks go and borrow a lot of money. And they borrow that money and they now invest in the stock market. So what happens when the share price goes down this time, it's not just markets going down, it's banks going down, it's insurance companies going down, it's families losing their breadwinner, it's suicide. People are dying because they've taken a lot of margin to trade and they lose the money. So it's not, share prices will always go down. I can guarantee you today that share price is going to go up and down for the rest of your life. The problem is the leverage you have. So when you scale out, you're saying, yeah, I made some profits. I don't know what Carl is saying about stop loss. I'm going to just sell some, pay my margin, and I now own the stock. I can now sleep well. It's my own stock. That's also a strategy. There's stop lossing, there's scaling. The point is you've got to manage your trade. See, we talked about what you do before you start to trade. Now we're talking about what you are doing when you are in the trade. This is what you are doing when you are in the trade. Emmanuel, I added you. You went up. I'm going to add you again so you can ask your question. Yeah? Let's continue real quick. Now we've come to the end, right? Not to the end, the part 3. You see, the part 1, we talked about what to do before you trade. And we said before you trade, know your market, know the stock or the market you want to buy, the particular asset class you want to buy, get your trading budget, determine what is your per trade volume, get your triggers. That was before. Then we'll talk about when you are in the trade. When you are in the trade, we say put your stop loss or you put your scaling. That's when you are in the trade. Now I want to talk about what to do when you want to come out. Because, okay, now you are in. You've made profit. Okay, how do I come out? Do I just sell everything? What do I do when I want to come out? So there are 3 ways you want to take your profits, right? Number 1, you can just have a target. This is a discipline again. This is why people get into trouble. Because what happens is that when people make money, they get greedy. You know, we said right at the very beginning how you will get in and how you will get out. If you said, I want to get in and I want to get out at 25%, people will now make 40% and stay in because it's greed. You're no longer being disciplined. You are looking at the emotions. Oh, I can make more money. I'm more than 50%. This is just how to get out. So you can have a fixed target. If I'm double my profits or my cost, I get out. Or I'm going to get out my cost of margin immediately and I'm going to stay in. Or I will just keep on trailing. I'll trail this share price forever. If the share price goes to 1 million, I'm not selling. I'll just move my trailing price up. Whichever you want to do, stick to it. Don't change during the course of the program. If your plan is to say, once I trade, I make 50%, I'm going to exit, do it. Don't say, oh, I'm going to lose money. There's money on the table. That's your plan. You set that plan up. So stick to your plan. Or if you say, if the stock price gets to 50%, I'll sell 25%, I'll stay in. Do it. If you say, no, I'm not going to sell, I'll just keep on trailing my stock price till I get to the end. Do it. The point is be disciplined. Have a plan before you get in. Have a plan when you are in. And have a plan on how to get out. If you don't have a disciplined plan, that's when you let emotions come in. And humans are irrational. People say, this stock is my baby. I can't sell it. It's not your baby. This stock is money. You don't marry a stock. You have to be very cold and you sell things, right? If you get emotional, that's when you start to lose money. So how to take profits? There are many options, but there's no right option. Whatever option you say is the right option, stick to it and make sure you are executing it. Yeah. So again, I'm giving you a start on taking the profits route. It's still the same thing. It's going to be, let's say I bought Bitcoin and I hit my target. Don't be greedy. Sell, move on. Sell, move on. Have your target exit written down. I'm going to share with you guys a free template for your trading at the end of this slide, at the end of the presentation. I'll post it on Twitter. You can print it. You can adjust it. It's yours to use. You can redo yours. That's fine. You can go online. It's not a secret. You can go online and find it. I'm just going to give you a free one here. So have your profit and keep to your profit rules. If you buy something and you say, my top line is 50, even if you are trailing, if that's your target that you don't want to do trailing, you get to a certain percentage, you sell, stick to it. If your target is to trail, stick to it. Remember that trailing only works when there's a market. So if you are trailing a stock that is not liquid, where are you going to sell it to? So be careful. Again, let's go back to the first point. Know the market and know what you are doing. I don't know if I should mention the name. Well, I think I can. There are many stocks in Nigeria has something called free float. Not Nigeria. In the stock market, something we call free float. Which means if I'm, say, Bua Cement, I have to have a certain percentage of my stocks out there for investors to buy. You can't trade if there's no volume. Tweet that. You can't trade if there's no volume. It is the volume that creates the arbitrage and the trading. So if there's no volume, you cannot trade. So do not trade a stock, even if it's profitable, that has no volume. And you can see volume is right there in the stock trades. They always post volume. If they post NTA, they'll tell you NTA news, oh, stock price today was 5 naira. This stock went, they always give you volume. If there's no volume, don't go near it. So if I trail a stock, for instance, like Bua Cement that has no free float, because why it doesn't have free float? Because in Nigeria, we use the value of your market cap sometimes to replace the free float criteria. I wrote an article on that, and I said we should scrap that capitalization rule. You must have free float. If you don't have free float, don't use. So what I'm trying to say is this: Nigeria will tell Bua that if your capital is maybe 20 billion, you don't have to have 10% free float, just for example. So you see a highly capped stock in Nigeria without free float. So if you then don't understand Nigeria and you want to trade in Nigeria, you say, okay, give me the highly capped stocks in Nigeria, because or in America, highly capped stocks are very liquid. So you come to Nigeria and say, give me the high cap stocks in Nigeria. They give you Bua Cement. You go and do Bua Cement, you buy it and you put trailing. So you then trail, it goes down. You say, okay, sell on. It's not going to work because there's no volume. There's nothing. You can't. You see what I'm saying? So knowing the market is as important as trading. You can't go and buy into a market you don't understand the nitty-gritty. If you don't know all this stuff, don't trade. Give your money to someone else that'll trade for you. Don't go into a market you don't understand the nitty-gritty. This I just told you now. How many of you knew there was free float rules and the difference? If you don't know, don't trade. It's that simple. Again, we're doing disciplined trading, right? And that's what I'm trying to just emphasize to you here. So let's come to I have a simple trading process for you, right? Simple. If you want to copy this slide and print it and save it in your bathroom window, go ahead and do that. Number one, pick your target. Pick your target. When you pick a target, it doesn't mean you're going to buy that share immediately. It just means you are watching it. So you are saying, you've told your computer, I want to trade stocks that have a high volume, low price. Okay, your computer will start watching it for you. When I mean computer, your stock screener. You can, if you go to most of these apps, they have a stock screener. You can give it your criteria. Let it be a highly capped stock. Let it be in Nigeria. Let it have volume above 10 million. Let it be the highly talked about stocks. Put everything there. Let it be on Wall Street, whatever. Let it be there. That's number one. You watch the stock. Number two, you know your entry price. So once that criteria, that is triggered, you go in with your lot size. So you already have your lot size. You already have your entry criteria. So when you wake up and you see that, wow, volume is 10 million, Trump has tweeted, my girlfriend, whatever it's your criteria, that triggers your buy. You then enter with your agreed lot size. You don't say, let me invest 5,000. No, you invest with your agreed lot size. Discipline, right? You then do what? You put your stop loss. If the price falls, you are out. What have you lost? You've lost 2% because you put your stop loss at 2%. You've lost 2% or 1% or whatever it is your stop loss. You are out immediately. No emotions. You don't say, no. I like this guy. He's a maverick. No, you are in, the stock price falls, you are out. Or you are in, stock price goes up, you go up, you move your stop loss up. As the stock price is going up, you keep on moving your stock price, your stop loss up, or you do a scale out. Again, guys, discipline. We're not doing emotional stuff here. We're trying to be very, very disciplined in how we trade. So 1, 2, 3, 4. Make it very, very simple for you guys, right? Again, take profit rules. We've talked about this one. We're almost at the end. Let's talk specifically about margin. I mentioned it when I talked. I'm going to talk about it specifically because this is where people get into trouble. If it's your own money, remember we said when you start, you're going to ask yourself, what's your trading budget? You're going to say, I make discretionary income of say 100,000. And out of this discretionary income, I want to trade 20%. So you have about 20K as your discretionary trading portfolio, which means if you lose that money, you can go to sleep. Your trading budget is the money you can lose and go to sleep. It's not money you can make, money you can lose and go to sleep with your trading position. So I have 20K to trade, right? You have to have your plan. We've done all that. You say with margin, you are very, very precise with margin. There is no I beg. There is no I'm coming. You say, I want to buy this stock and I will exit at this price. What is that price you're going to exit? It's going to be your cost of margin plus your profit. So you buy at 10, your cost of margin may be 50. So you are saying once I hit 50 plus maybe 25, I'm getting out. Why? Because it's margin. Even if you are making a profit, you are paying margin. So you want to say once I make money plus I pay the margin, I'm out. Right? Then you can now take the profit you've made and buy that same stock yourself. Right? But if you stay longer, if you are using margin to stay in the stock a long term, you are just paying the broker. You are paying the broker's rent. So you need to be very careful with margin, because if it turns against you and you can't get out, you're going to get a margin call, which means the broker is going to tell you, hey, your stock has gone down, come and pay more to your loan. Right? So be very careful. When you are with margin, you don't want to wait. Once you do your break-even point and you go past your break-even price, once you make your profit, whether it's 25 or 35 or 50, you are exiting, because you don't want to have that open position. That's with margins, right? Guys, we're almost at the end, so let's have your questions now. I think I have some questions here. Let me give you my trading summary, just to summarize everything we're trying to do today. I think it's the second to last slide, and if you guys want to speak, I'll add you in here, and I'll go to Twitter and look at your messages as well. Number one, what did we say you guys should do? Put your key trading rules. Put your stop loss before you enter. So before you start to trade, you already know what your stop loss is, right? Risk only 1 to 2% per trade. You move your stop loss to your break even. That's your target. Once the stock price has to move up, move your stock price to your break even. That's where you are rushing to. Take your partial profit. That's the scaling. So if you are doing stop loss trailing or you are doing scaling, know which one it is and then execute that once the price starts to go up. So you can take your profit. I think in this case we're saying take your profit, pay your margin guy off, then trail the remaining position. That means if I borrowed 10,000 naira and the share price gets to a place where I can pay back that 10,000, pay back the 10,000, then trail the remaining with your own money, right? Because that way you are no longer handcuffed to a margin guy. You're not paying anybody to fee somewhere. It's just going to be left you just trailing that trade till it starts to hit resistance. Then you basically go out, right? So write these rules down. This is a very, very disciplined way to trade. There are more things we haven't talked about here, but guys, we can't talk about everything. But at least even if you took away from this presentation of stop lossing and scaling, I think you are fantastic. So I'm going to share these 2 slides with you guys. I mean, you can print it out yourself. This is your weekly review session, right? So you want to write down things that you do. Why are you writing down things? Because remember we said that you are only trading based on your triggers. When you start to write things down, you notice that there are certain triggers that make money for you. If, for instance, let me use an example. Don't hate me. I'm just giving an example. If, for instance, every time Trump tweets, oil price goes down, and you write this down, you can then build a strategy around just following Trump's tweets and buying and selling stocks. That's the point we're making. If interest rates go up and GT Bank shares go up, that means that GT Bank is sensitive to interest rate stuff. But how would you know if you don't write them down? So what are your trades? What's your win rate? What's your win rate? Remember, what are your trades? You are trading 2% per trade. Of that 2%, how many trades made you profit? So you did 2%, 2%, 2%, how many made you a profit, right? What's your average return, right? And then what was your biggest mistake and what will you improve on? Journal things down. It will start to show you where you are doing good, where you are doing bad, and where you need to go and work on. We need to go and ask someone for help. Explain RSI to me. Explain volume to me. It helps you to write things down, right? So that's the first one I want to do. Your weekly review. Do a weekly review with yourself or with your broker and see what you're doing well and what you're not doing well. I also have this 1-page template for you guys, right? Again, just copy it out, print it out. It's on Twitter. Just copy it out and use it. Just every day, just change the dates, put the dates there. You want to ask those questions before you trade. So see, I'm asking, number one, what asset class will I trade in? Is there number one? If analyst what you want to trade, write yours in. What asset class and what market am I trading in? You want to know that before you even get in. What's my total trading capital? And how much am I going to risk of that trading capital? You have to know that before you trade. What's my maximum daily loss? This is my stop loss. What is it going to be 2%? What's my maximum weekly loss? So we've touched this. You have to do this before you trade. Then what's my position size per trade? What's my minimum? What's my lot size? What's my maximum? Again, you do this. Frequency. Am I trading daily guy? Am I trading weekly? Write it down. What's my entry criteria? What are those triggers? Is it Trump tweet? Is it the interest rate? What's triggering me to go after a particular share? Very important, because if you now start to put these things I'm asking you, if you have a year's worth of this, now we have ChatGPT, we have AI. If you scan all this stuff to ChatGPT, it will tell you, based on your 5 years of this template, I noticed that every time interest rates go up, beggar pains go up. That's what it will tell you, because you are giving it data. This is the data that you see those trading guys paying for. That's what you're doing. The more you give it data, the more it can give you analysis of that data. So start to write things down, right? Number 5, what's your stop loss rule, right? Are you going to do initial stop loss at what price? 2%? Okay, do you trail? Do you scale? What's your final? Do you say, even if I'm trailing and it gets to 100%, do I still continue? Or do I just close out the position? Write it down. Where do I take profit? Do I take partial? If I'm scaling, do I take at 25? Do I take at 50? Write it down. What's my trade management rules? I will not add losing trades. Is that your rule? Or I will not stop trading if my daily limit is listed. What's your rule? Stick to your rule. Of course, journalize, put everything. If you can put all this stuff on, say, Excel, it would help you, because you can copy it or feed it into a program, and it will give you analysis. That's what you use AI for. So AI will make you a better trader. Folks, thank you so much for listening. If you guys have great questions, I am here. I'm going to go to DM. If you guys want to add yourself to speak, I'll add you if you have a question. Otherwise, I'm going to go to DM. And I noticed, yep, I hear you. So explain trading loss. Like I said, your trading loss, you put your trading loss where you are wrong, not where you are right. What I mean is this, right? If you say, that's your question, right? You are asking, where do I put my trading loss? If you make a bet and you say, let me give you another example, that every time Trump tweets, share prices go up by 2%. That 2% is you are saying that's your theory, that share prices go up by 2% when interest rates go up. So you put your stop loss at 2. Because that's where you are wrong, right? If you are right or wrong, it's based on this 2%. So I'll put my stop loss at 2%. You put your stop loss where you think you are going to be wrong. You said the share price is going to go up, right, by 5%. So you bought that share. What stop loss should you put? 5%. So if you are wrong, right, then that is taking you out. Because you are wrong at 5%, is taking you out at 5%. Does that make sense? That's where you put it. It's not mechanical. You can do a mechanical 2%, or you can do it this way. Where you think you are wrong, put the stop loss there. Kenny, hi, what's going on, Kenny?
Oh yeah, sorry. Sorry, where are you doing your presentation?
On YouTube.
On YouTube. Sorry, you don't even share it. I didn't know the name, so I'm listening to it on this space.
If you go to the tweets, you'll see I shared out the YouTube address.
Yeah, thank you so much. Let me just go to my question real quick. So does app like Robinhood, does it have like this stop loss?
Almost.
Does it have that trigger?
Yes, almost all the apps, Robinhood, Bamboo, almost all of them have stop loss. Yeah. So if you go, when you are placing the trade, it will ask you, do you want to buy the share? You will see stop loss. You'll see it there. Yeah. So when you do that, Kenny, you go back tomorrow. If the share price has gone up, just adjust that stop loss. It will keep on going up and up and up. Yeah. Make sense? Kenny? Kenny, you're muted.
Can you hear me?
Yes.
Yes. Yeah, sorry. The last question I have for you is that, do you do like a boot camp personal paying for your service,
Not
or
really.
just trading, maybe like a 2 weeks crashes and pay for your service, then that's it.
Not really. But let me give you an app. Let me give you an app. Kenny, I'm going to mute you. You have an echo. I'll mute you. Okay. So Kenny, go online. Go to pul.llc, pool.llc. So if you want to talk to me, right, go to pul.llc. It's like a personal finance page. Just plug your information there, right? Then tell me, Kalu, I plugged this, gave me this. What do you think? What do you think? I'll talk to you, right? I don't do all those. I don't do any boot camp and all that. This is just pro bono. This is what I do in real life, a real job. But I want to get the folks that are trading in Nigeria and everywhere, get their discipline up and all that kind of stuff. Yeah. But if you go to the pool.app, it's a personal finance website. You can go in, you can put all your information, right? It will give you answers. It will tell you you are doing this right, you're doing this wrong, you are trading this, you don't have insurance, you don't have this, pool.llc. Then you can share with me and tell me, hey, Kalu, this I don't like what this thing's telling me. What do you think? And then I can see what you're talking about and I can maybe give you, yeah. Does that help?
Thank you very much.
Send me a DM. Oh, yeah. No worries.
I would surely do that. Thank you.
All right, folks. Okay, other question I have. I like the questions. Why don't you guys like to ask questions? Why do you guys do? So someone's asking, is scaling the same as dollar cost averaging? Yes, kind of. Scaling is kind of like dollar cost averaging because it's the same principle. It's saying as you are going, you can use scaling to get in or to get out, right? You can say, I want to get in. Let's go back to scaling. You can say, I want to get in by buying stocks one at a time, or I want to get out by selling stocks one at a time. The idea is to reduce the scale of your position or to increase the scale of your position. That's essentially what you're doing. So again, go back to what's happening in South Korea. If those guys had done what we just said here, they won't be in any trouble, because if they had bought SK Hynix and they had put their stop loss, right, they would have gotten out. Or if they had scaled, they would have gotten out. What happened to them was pure greed. You buy a stock at 101 and it's $1,000,000. It looks like you're stupid if you sell it. But now look at who's crying. But if you had sold, taking that profit, right, take your own personal profit, pay off your margin, and then go back into the market with your own capital, then you won't be in a problem. If you lose your own capital, no problem. But if you then do this, what's it called? You want to trade with margin, because margin gives you excess rewards. Margin gives you excess rewards. That's why you get into trouble. So be very, very careful about margin. It's like, it's steroids. It makes you run faster, but you crash faster. Just ask the guys that have done that. Yeah. Another great question here. Lot size. You are saying that I should divide my trading budget into lot sizes. Does that mean I can only buy a particular share 2%? No. It means when you are trading, you only buy 2% per trade. So let's say I have my total budget is 200,000 naira. And my lot size, just to make it simpler for us for math, is 10%. If I want to buy GT Bank, that means I'm only going to place an order for 20,000. Not for 19, not for 21, for 20, because my lot size is 10% per trade. So if I want to buy GT Bank 2 times, I will say I want to do 2 trades, 2 lot trades, 20. So I bought 40. It's not, I can have, if you want to, I don't recommend it, you can have 100% GT. But when you are buying per lot size. You are buying 5 or 10% per lot size. So the guidance is that don't trade more than 5% or 2% per lot size. Set that up. Professionals say it's 2% for a reason, because you don't want to be overextended. It makes you stop. Because when we say 2%, it looks a lot because it's 200,000. What if you had a portfolio of 20 billion to trade? Then 2% looks material. So I hear you. If you are trading at a smaller scale, yes, you might want to maybe increase your 2% because that makes more sense, right? But these guys that are giving you 2% are trading with billions. So when they say 1% of a billion, it's a lot of money. I get it. But whatever it is you want to do, stick to it. It forces you to ask yourself questions and say, is this right? Is this wrong? So you won't say, let me just put 1,000 here. No, it will force you to say, if you really think this stock is a good stock, then commit 10% of your principal to that trade. If you can't commit, that means you don't really think it's a good stock to buy. So go back and commit. That's what that's what is forcing you to do, right? Okay, I prefer the guys speaking, so I have to read because you guys repeat the questions. If I have to read, I have to stop, read. It's hard to read and talk at the same time. This one is asking about trailing stop loss. So essentially, if I understand what you're saying, Dimeji, yes, if the stock price is coming down, you don't have to sell. It's not conflicting with the point about scaling and selling. There are two methods. If I'm doing trailing, I am saying that if the share price is going up, I'm moving my stop loss up. I can decide to scale if I want, but what's triggering me to sell, it's once the share price goes below my stop. That's if I'm doing trailing stop lossing. If I'm doing scaling, I'm not interested in this. I'm going to say I'm going to sell at 20% or 10% or 5% of my profit. That's a different one entirely. So scaling just means once the share price is up, I sell. When the share price is down, I sell. You see it? But this is basically going to say, hey, I keep on moving that price up. Why would I sell? So again, that's your question. The second question: why would you sell a stock that's going up in price, even if you're a trader? If you bought a stock at 10 naira and it's at 100 naira, and there's still more demand for it, why are you selling? Why are you selling? Because what does demand mean? Demand means there's a lot of bid. Remember when we had the Bamboo guy here? He was saying that there's a liquidity meter on Bamboo. So when you look at your meter, you see the stock is highly liquid, and you look at your order book, you see the order book, lots of people want to buy. Why are you selling? Why? Because you're a trader, why are you selling? So if people are buying and you are still in that trade in the black, you are still in the profit, then why are you selling? Just wait. So that when you wait and you know there's sufficient volume, once that price starts to come down, what is price coming down? Price coming down means volume of sales is now entering the market. People have seen that, oh, people want to buy this stock, so they're now selling their stocks. When people start to sell, you get out. And you're getting out professionally disciplined through a trading stop loss. So there are two different things, right? And it's your second question. If you are in the trade and the trade is showing an order book of bids, which means more people want to buy, there's high demand for the stock, you don't get out. You sit right there. You ride that baby up, right? Once the stock starts to show supply, which is more bids, then you get out. Make sense? Please explain what is options trading and leverage. Ooh, Emmanuel, now you're entering shark infested waters. So when you're talking about option is just an option to do something. An option to do something. I don't want to advise anyone. You need knowledge to do that, right? Essentially, what it is I can buy the option. Let me give you a good example. I used Arsenal. I wrote an article on options. If you go on, I can write for Nairametrics. If you go on Nairametrics, put my name, Kalu Aja, options, it should pop up. I wrote on Nairametrics. Let me give you a good example how it describes options. If you are an Arsenal fan, you can buy the option today that Arsenal will win the EPL next year. Let's say you bought the one last year. You bought an options that Arsenal will win the EPL last year. When you bought it, it was 100 naira. Because everyone says Arsenal will win, Arsenal never wins. So it was 100 naira. Then when they got to midway season, Arsenal was ahead, but Arsenal has always been ahead and they never win. So it was still maybe 150 naira. But the last 5 games, what happened? After that West Ham game that the VCR, what's that thing called? VAR took away the equalizer goal. The Arsenal option will now go to like 1,000. Because now it was clear Arsenal was going to win that game. So when you buy the option, you are buying the option to buy Arsenal stock at a price. What was the price of Arsenal at the beginning of the season? 100 naira. What was the price of Arsenal towards the end after that VAR call from West Ham? 1,000. What would you pay for the Arsenal stock? 100 naira. You don't pay 1,000. You are buying the option to buy Arsenal at 100 at the beginning. You will still pay that 100 at the end. So what's your profit? It's 900. 100 you're going to pay, but the real value is 1,000. So you make $900 profit. That's why the guys that make a lot of money are the options traders, because it's a lot of profit, and options always go with leverage, right? So you imagine you are now saying you do a times 10 leverage. You bought it in January when Arsenal was just 100 naira. Now, after the West Ham VAR call, it went up to 1,000, but you are using margin to trade. So you see that you're going to make nearly 900,000 on that single trade. So that's options trading and leverage. It's very, very risky, because what if it goes the other way around, right? And you are the one that sold that option because you are a Chelsea fan, you don't like Arsenal, so you said Arsenal will never win the EPL, and you sold a put that Arsenal never win. So now when you sold that option, you collected the 100 naira. They gave you 100 naira in January. Now, is it August, when the Arsenal did that VAR call, that call came, the share price of Arsenal is now 900. It's now 1,000. You have to go and buy that stock for 1,000 and give to the guy that bought the call from you. You see the difference? So that guy that bought at 100, if the share price of Arsenal goes up to 1,000, he makes 900. But you sold, so you took the $100 first of all, right? Now the share price is 1,000. You have to go and buy a share. So you're going to lose 900. So that's options trading for you. Option is from agriculture, where farmers in those days were to farm and they didn't have cash. So the farmer will sell an option to a purchaser and say, I give you the right to come back to my farm after harvest and buy corn at this price. So what's the guy do? What's the guy paying for? He's paying for the option to buy corn at the price the farmer sells to him. So if there's corn harvest that year is bountiful, will the guy come back? He won't come back, because why should he come and buy corn that is expensive when there's corn everywhere? He won't come back. So he will lose his deposit. That deposit is the one he has paid to the farmer. So the farmer keeps the deposit. What if there's scarcity in the market? Of course he'll come back, because if he comes back, he can buy that corn at the cheap price that he paid with his deposit. Does that make sense, Emmanuel? All right, folks, guys, we've been here about an hour, 30 minutes. I'm going to let you guys go. Really hard to read the comments and respond, but you guys have got great comments. I will try to go back in and respond if it's possible on each of them. But I think you guys have learned a lot about trading. I just want to come in and do a lot of, should I say, I'm not saying what you're doing is wrong. I don't want to be take that liberty, but apply discipline to your trades and you can't go wrong with it, right? You apply discipline to your trades and then you can't go wrong. I've showed you how to trade without losing money. That's essentially what you want to do. Once you're able to trade without losing money, you then go to the stage 2. Trading 201 will be, what are those triggers that you want to look for that would allow you, right, to then get into this trade, right? Now we've talked about what to do before you go in, what to do whilst you're in, and what to do to get out. So if you want to do this space again, we'll do what are those triggers that keep you in, and how do you determine volume to also keep you in, right? That's what we're going to do next. So guys, thank you so much for all the messages. I appreciate you guys. Like I said, we have a personal finance app. If you want to try it out, go to the app. It's called Pull, PUL.LLC. It's fantastic. Go in. It's not a trading app. You're not going to trade. It doesn't trade jack. It just records what you're doing, your income, your expenses, your assets, your liabilities, and it gives you lots of insights. This is what you're doing right, this is what you're doing wrong. It tracks investment, it tracks insurance, it tracks your legacies. You want to basically do that so you can know where you are failing, right? Some of you are making so much money from trading, but you don't have life insurance. It's going to tell you, hey, you did something wrong. If you do that way, you're always going to turn out the best. So thank you guys for listening, and I'll see you guys next week again. We have tons to talk about, a lot to talk about. So I'll see you guys next week. We're playing the Commonwealth Games, Nigeria's doing very, very well. Very, very pleased with that. So guys, take care. Thanks for watching, and I appreciate you guys, and I hope I'll see you guys. Next week. Thank you and bye. My name is Kalu Aja, and I'll see you guys next week.